Okay, let's go.
Hello, this is Volatility Bongo, and I'm joining you on February the 5th, this 126, and we're here to discuss the UVX long-short strategy. And this is a strategy I've been building with Tiger Quant, and essentially we're taming the widowmaker, turning volatility into a harvestable asset class. So let's get into it, MomentumX community. So here's what we've been working on, and here's really the alpha proposition. The opportunity that we're looking at is the fact that most people and most funds treat the UVXY, really any volatility product, as a lottery ticket. But it's so much more than that. And because they don't understand it, they often just lose money. It's a widowmaker. And, volatility in the market has lost many people a lot of money. So here's the proposition. Let's look at the opportunity. Volatility is traditionally one of the most misunderstood asset classes in the market, and most people treat it as a lottery ticket. You buy on the spike, but you lose to decay. And so we look at it much differently, and here's where our edge really comes from. We think of volatility as a bi-directional asset, and our engine can capture rapid fear expansion and harvest long contango decays over time. And the end result of that is a CAGR of about 920%, a Sharpe ratio of 7.9, which is basically unicorn status, and a probabilistic Sharpe ratio of 100%, which is an additional measure of how valid that Sharpe ratio is. That's very good to see. So we did a back test, and we're in the middle of forward testing this strategy in 136 days. And we did it a couple of other rolling back tests that were similar over 5-year periods. Sharpe ratio of 7.9. And we got a Sortino ratio of 10.3, which is essentially the same thing as a Sharpe ratio, but it really measures downside efficiency, and it doesn't treat upward volatility as a bad thing, because essentially you're capturing return if you capture upward volatility correctly. And throughout all of this, we only have a maximum drawdown of 25.14%. So what's a drawdown? Essentially, whatever your highest value is, you're 25% below that. Before you recover, and we're winning 74% of all trades. So essentially, we have a win rate of 84%, but because of how volatile volatility is, we're slipping about 10% as we're optimizing and controlling for larger drawdowns. So there is a bit of a trade-off in having lower drawdowns. You reduce the return and the win rate, but risk management is very, very important for any trading strategy. So here's how we look at it. Our core philosophy is, how do you harvest bi-directional volatility? So you have one state as an overarching theme, and there's many states within this that we can get into, but essentially you have fear expansion in a very short amount of time. So it's a rapid spike. You might see 100 to 200 to 400 or more percent in a very short amount of time. It could be days, it could be weeks. And then after things have kind of exploded, you have a very long decay, and that is the fear contraction. And so what this strategy does differently is it's adaptable to both realities, and that's why it's so successful. So we can capture large spikes, and we can harvest very long contractions in fear that happen 80 to 90% of the time. And we're allocating about 100% of all the capital that we have with a robust risk management system to make this possible. So when I talk about states, I'll discuss that later, but essentially here is what a visualization in TradingView might look like, and really what we're doing. So we took the inverse of the UVIX, because transforming it makes it smoother and easier to understand, and essentially all the signals like on this chart and this line are flipped. And so the blue is the VIX, the green is the UVIX, and our actual trading signals are from the inverse UVIX. And what you see, that looks like a sell signal, but it's actually a buy signal. And it tells us that volatility is going to spike. And if you notice, it's signaling right before a massive ramp up in 2020. And then we kind of catch near the bottom and flip, and we get out with a very, very large spike in volatility, over a couple 100%. And then you notice again here, it flips to a buy position, a short position, a buy position, and a short position. And essentially what we're doing is we're going long and short, and our signal is on a smooth inverse UVIX, and that's quite effective. And when we tried to just do it on the UVIX itself, it was close to 54% efficacy. But if you notice over here, we're right about 85% of the time. And you might think that 920% is really high, but let's step back and think about this conceptually. If you were right 85% or 84% of the time on an asset that in an average day can move anywhere from 10 to 30%, 920% is not an unreasonable number if that holds out to be true. So that's kind of how the signals work, and they feed into the system. And so essentially, that is this. We get raw price action signals, and we get volatility information, and then that is processed into the algorithmic core, which gives these signals of when to be in and out. And then it either is, hey, volatility is going to rapidly expand, or volatility is decaying. So we're either going long and short based on these signals, and then you have an executed trade. Now, between those signals, risk management is super, super important. So we have advanced exit logic, and we tried many things, but what we found was most effective was using standard deviations, or sigma, and we played around with a lot of parameters, but what we found was, and I know it says 3 sigma and 6 sigma, but 4 standard deviations and 8 standard deviations were wide enough to capture black swan events, but also narrow enough to not cause major losses. And what we're doing essentially is taking profit at 4 standard deviations and taking profit at 8 standard deviations, and we're taking about 50% of the money off the table. And the reason we do this is, it might ride for a bit longer, and we don't want to completely compress returns and remove upside, but we also want to manage downside risk. So this, and what it does is it calculates these independently for longs, and it calculates it independently for shorts. And we're not actually, the input to calculate standard deviations, we played around a lot, but it's actually the volatility of the UVXY itself. And the resolution is super important. And so we're using about 360 periods, which is curious because the signal is every 6 hours, if you noticed on the chart. And we're getting harmonic resonance, right? Because the risk management system is on the same time frame as the signal system. And you'll get these curious things like harmonic resonance when your risk management system matches your signal system, or it might be a golden ratio or some other mathematical or physics property. And I would encourage you to think about this as you're building your strategies. Now, why did we have to put this in? And why did we have to put advanced risk management? Well, this is also 2020, and it's slightly after that massive ramp up in the VIX. It's kind of over here. But if we zoom in and we look, we get into an area called Sharpe. And this is really a problem for trading volatility because we're in a range of the VIX, of the UVIX, that it behaves in a sinusoidal function. It's one of the state behaviors really between 15 and 25. And the upper end of 25, it starts behaving in a parabolic fashion. And then under 15, it starts behaving in a linear fashion. So it's a really complicated area, and you have to have very adaptive risk management. And I'll show you why. So essentially, we enter along right here, and it makes a bit of money. It makes about 12%, and I know that's a bit hard to see, but it's up 12%. But then it starts to whipsaw in a sinusoidal way, as you can see, and then it drops a bit. And again, that's hard to see, but I believe it drops about 24%. So using risk management, we're out, right? And we're not bearing the full loss of that without risk management. And again, here's another example. It tells us to go short. We make a good return on that, and then by the time it goes all the way up to 11%, we've already triggered our risk management, it's taken profit, and the short is fine. And so when you're trading volatility, risk management has to be adaptive, and you have to be taking money off the table at all times, or at least looking at it, because it has multiple state behaviors that are irrational. And so here is our risk architecture. We have a couple of things. We have hard stops, the shorts and the longs at these percentage points, and they're different because the longs and the shorts behave differently. And actually, the majority of our drawdown is from longs because of how wide and how volatile they can be. And specifically to the chop, we built a portfolio circuit breaker. Now, why did we do this, and what's a circuit breaker? A circuit breaker in stocks is essentially if there's a move that's large enough over time, you shut it off. And we did that for the longs, because essentially what was happening over here is we'd have a couple of long positions create 12.5% losses, but they'd start to stack up over time. So instead what we said was, well, if we at any point during this period of time experienced a 25% loss, which was what we found as optimal, you shut longs off until the short positions restore the high watermark or your highest value. And that worked really, really well. And that tells us a couple of things. It tells us that the shorts are incredibly profitable, and they're less problematic. But you get a lot of profit from being long, so we wanted to keep that in. Now, we tested this through 2020 to 2025 for a specific reason. We had 4 separate regimes that I'll walk through, but I'll give you an overview. We had the COVID-19 pandemic where the economy shut down, and there was a 1,000% spike. And I'll call out that this is on a log scale in case it looks weird, just so you could see some linear behavior. It's actually exponential. We had meme season, where people were buying stocks indiscriminately with no theses, no catalysts. It was irrational exuberance. You had war with Russia and Ukraine, and then you had an AI boom, which is technological change. So 4 very distinct regimes, and we're going to walk through what those look like. So COVID, this is what a volatility regime during COVID looks like. There is a massive ramp up before calm, and the inverse UVIX is kind of a bit high, and then it drops, and it's almost like a meter to the COVID and the UVIX spiking. And you'll notice that the UVIX kind of fires a little bit later than the VIX. So there's some risk management things that we do there that we can't discuss. And then there's a rapid decay. And then, for some time it's choppy. It's not deciding where it's going to go. And within like these periods from like June to November of 2020, if you're not dialed in on your risk management, you're losing a lot of money. So that's kind of what the economy shutting down looks like in terms of volatility. Meme stocks, where the market's just going up and going on a tear, volatility is pretty flat, right? Volatility is decaying, and the short side is really winning here. There are some, relative changes that look accentuated, but if you look at the actual VIX, it's not really moving much. It's kind of moving between 0 and 50%. So, if you want to harvest a regime that looks like this and a regime that looks like this in the same program, you have to have logic that's adaptive. It can't be linear because the VIX doesn't behave in a linear way. It has 5 state behaviors. And this is what the Russia-Ukraine war looked like. And it's interesting. It's not actually that volatile, but you see a wider range of behavior between about 80%, right? So you're kind of in that sinusoidal to linear to parabolic arc throughout all that time. And towards the end of it, when people become comfortable, things are starting to kind of calm down. Volatility is going down. And then we have, in kind of now, we have rapid technological change. And you have sometimes, like around, Liberation Day, which is here, the volatility tsunami caused by the unloading of the Japanese debt market and the carry trade. But for the most part, volatility is decaying. And so you want to be able to harvest these spikes in volatility, but also take advantage that for the majority of the time, volatility is declining, right? So you have to be alive to both realities. So here's the summary of what we've gone through. We have an adaptive algorithm that we fine-tune to deal with the 5 state behaviors of volatility. And in this order, they're linear from 0 to 15. 15 to 25 is sinusoidal on the VIX. 25 to 35, things start behaving in a parabola. So if you remember the quadratic equation, from 35 really to 50, things start to get exponential. And then 50 onward, the VIX becomes a black box, and the UVIX, consequently, which is a levered volatility future, also starts behaving that way in a really accentuated way. And so, two, we have some statistical arbitrage techniques that we've put in that help us monetize the structural decay of the UVXY. So what do I mean by structural arbitrage? Well, we built this strategy, but I spent a lot of time going through the prospectus and doing the math on how it behaved, and we adapted a strategy for the reality of the instrument. And when you're building trading strategies, not only do you have to think about your signals and what's going on directionally, you really need to think about what you're trading and how it behaves. And that's an arbitrage in and of itself. It can really aid or hurt your performance if you get it wrong. And then three, you have to have really smart risk control that's simple. Because if anything fails in your risk control for whatever reason, you're going to find out very quickly, and you may lose a lot of money. So, when you think about winning trades, or you think about a winning software program, it's not 1 + 2 + 3 equals the result. It's 1 × 2 × 3 that gives you your probability of success. You need a very good adaptive algorithm that's right 84% of the time. You need a very high percentage of understanding on what you're trading, or a knowledge arbitrage, and then you need effective risk control. So really those things are multiplying each other to form the success, and that 74% win rate is essentially three numbers in those three categories multiplying together to form 74%. And if you're, for example, at 0.2% on any one of them, that drops quite drastically. So I'm Volatility Bongo. This is the UVXY strategy that we've been testing and we've been building. I'm happy to talk to anyone in the MomentumX community about volatility or derivatives trading. It's what I think about all day, and thank you for spending this time with me. And I hope that you have an understanding now of what we've been working on and what we've been building. And I'll see you next time.